Today, we're going to build a strategy that has a 118% annualized return over a 10-year period, beats the S&P 500, and turns $10,000 into $23 million. This is the part where I tell you that this is not financial advice and past performance is not indicative of future returns, but let's hop into the strategy. So in the last episode, we essentially talked about the relationship between stocks and commodities and how those cycles usually flip every 15 years or so. Again, if you haven't seen the video, go watch it. But we're going to take that same kind of knowledge and apply it to this video today. Okay, so we're going to start with a if statement. And what we're going to look for is the move average returns of the past 400 days, and we're going to use the asset SPY, the S&P 500. And we're going to say if it is greater than the move average return of, we're going to make this one a bit smaller just to give us some buffer, 385 days of the DBC. And the DBC is a commodity index fund. If the S&P 500 is doing better than the DBC, we're going to invest into the SPY. But if the DBC is doing better, we are going to invest our money into DBC. We're going to run it back to 2012, and you see that it actually kind of underperformed the S&P 500 by a little bit, but once we got to here, you see a massive differentiation where the SPY is currently crashing, but the DBC is actually investing in it now, and we're on a uptrend. Again, the reason for this is because typically every 15 years or so, we have equities and commodities start to diverge. And when that happens, it's typically better to flow your money into commodities as a hedge, especially during inflationary times in the markets. Okay, so we're going to start building the DBC side of the strategy because it's a bit simpler. What we're going to do is I'm going to name it just to keep it organized, DBC bullish, and we're going to do an if statement. And we're going to look for the exponential move average 100 days of DBC is greater than the exponential move average 400 day of DBC. And we're essentially going to do a risk on, risk off strategy with this design. So I went ahead and drew some colorization on the charts to kind of help you guys visualize this better. Essentially, anytime you see the bright green, that means the 100-day move average is above the 400-day, and the 400-day is the darkish area. So whenever we are green here, that means that this strategy is on. So the on here is going to be DBC. Now, if it's off, for now, I'm just going to put a little placeholder, and we're going to do the SHY, which is just a treasury bond. It's very low yield. Oops, not S. I'm going to do SHY, and that will essentially turn it off if we're in the black area so that we're not losing money. And lastly, down here, you will see that I actually have a compare. So this is the average returns of the S&P 500 versus the DBC. So DBC is in yellow, S&P 500 is in orange, and you can see for the majority of this time frame, the S&P 500 was beating the DBC until about here, where now DBC is bullish, whereas the S&P 500 is collapsing. And the strategy that we're building shows that exact same. You can see that this point right here looks almost identical to this right here. Okay, so now we're going to rerun this back and looks good. But we're going to change one thing. I'm going to go ahead and paste in a sort function here. This is looking 60 days back to cumulative returns. And essentially what this is doing is saying if the S&P 500 is doing worse than DBC, it's going to go to the DBC. But if DBC is below its 100-day move average, it's essentially going bearish and going down, then it's actually going to flip to the sort function, which is going to find the best asset to park the money in to kind of hedge or protect the investment so that if anything goes wrong, it's not going down with DBC. And it's essentially going to look through a few ETFs, EFA, which I believe is a world ETF, but it excludes Canada and US and I think maybe some European countries. EEM is emerging markets. It's usually Asian and Pacific and developing countries. TLT is 20-year US Treasury bonds. Treasury bonds are not doing well right now. This is TLT, and it's not doing well right now because inflation is increasing and the Feds are increasing interest rates, which is demolishing TLT. But we can see in times like the housing market crash, TLT actually skyrocketed, and that's because psychologically people tend to move their money money into bonds to protect their investments or gold. But back in 2008, interest rates and inflation wasn't an issue. This time around it is, and when inflation is an issue, bonds typically crash. And then lastly, we also have EWS, which is Brazil. This is actually correlated to commodities. So Brazil is a big exporter of a lot of food throughout the world. And during these crazy times when commodities can do well, Brazil sometimes does really well. So we just have that in there for whatever. And then lastly, we have SHI, which is basically a less volatile version of TLT. So this kind of wraps up the bullish DBC side and the protection side of this strategy. So again, if the S&P 500 is doing better than DBC return-wise, we're going to invest in the S&P 500. If it's not, then we're investing in DBC. And then if DBC is actually bearish and its 100-day is below its 400-day, and we're in that black mode, it's going to switch to one of these investments and kind of just hedge and protect the assets. If we make some returns during that period, that's fine, but we're not really looking to make any kind of crazy gains with the hedge strategy on this side. But now let's build the aggressive bullish side of the strategy, and this is how we're going to get that $2.1 million return. Okay, so I went ahead and kind of built a visual logic system for you guys to see, so it's just easier to see when it's on a screen. The first part of the strategy is looking at the 400-day move average versus SPY and DBC, which we have right here. So you can see when the yellow line is above the orange line, we are investing in the S&P 500, but right now the S&P 500 is dropping. So DBC is doing better, so we're investing in DBC. And then you can see the logic, SPY greater than DBC, we invest in the SPY. But if DBC is doing better, then we go down here. And then we're looking at the DBC 100 EMA versus the 400 EMA, which is right here. And then if the 100 is above the 400, which is green right here, so whenever we see green, we're investing in DBC. But if we're below, that is in the black area, then we're going to that sorting hedge that we put into the strategy here. So I hope that visualization helps you guys. Now what we're going to do is build the bullish side of the strategy, and this is where we're going to get that 2.1 million return. All right, so we're going to start by deleting the S&P 500, and we're going to add another if statement, and it's going to be, we're going to do the 100-day move average versus the 400-day move average of the SPY, and essentially the same thing what we did with DBC. When the SPY is bullish, that is the 100 over the 400, we are going to invest in UPRO, which is a 3x leverage of the S&P 500. So it's only leveraged and bullish when the entire strategy is bullish, and I'll show you that visually in a second. And then if we're not, we're actually going to do just the sort function right now. And I think I'm going to delete Brazil just to keep it between these. So now if we rerun this strategy back, we're doing better. We're now up to $251,000, but we have this big, huge crash down, which is the COVID crash. But before we get to the COVID crash and fix that and profit off of it, I want to show you the S&P 500 and just kind of give you an idea of what the strategy is visually. So whenever you see green here, the bright green, we are essentially bullish in this strategy. And I went ahead and scrolled all the way back to 1970s, and essentially we have these big bull runs here where we want to be bullish, and then we have these massive collapses where we want to go bearish. So anytime the SPY is worse than DBC or it goes below the black line, we are going to switch to our defensive strategy. And we can't actually go back on the SPY, but on the SPX, which is the same, it's just the index that the SPY follows, we can scroll this all the way back to the 1970s. And I would recommend anytime you're building a strategy with move averages to, well, as any strategy, even if you can't back test it, you need to go back and look at it visually into the 1970s, the 1950s, the 1930s, and look at and try to visualize and understand how that strategy would perform through a 100-year period. So this is the 1980s. This is when we had massive inflation and we had a recession from all of the inflation and interest rates increasing up to like 16 or 20% back in the 80s. And it went bearish here again. And then we have the 1970s and the Nixon era, the gold standard, as well as the Vietnam War, where we were very choppy and oscillating. But yeah, that's kind of a walkthrough on the history. And now we're going to improve this more, and we're actually going to make a profit when the stock market crashes through COVID or any kind of black swan event. All right, so before we build this part that essentially profits during the COVID crisis, we're going to add a next function here, which is going to actually kind of scalp and capture profit when the S&P 500 runs too far. So we're going to do an if statement again, and we're going to say if the relative strength index of the 40-day period of the SPY is greater than a fixed value of 75, we're going to invest in UVXY, which is a short position. If it's not, we're going to do UPRO and run this back. And now we're up to $366,000. Okay, I went ahead and messed around with the numbers a little bit. I changed it to a 20-day RSI of the SPY is greater than 69. We are going to essentially buy UVXY. And if you look at the charts, what I've done here is this is the RSI of the S&P 500. And on the top ends here, whenever we tick above 69, typically we have a snapback, and the S&P 500 comes back down into position, into its relative range. So we're essentially capturing the strength. That's why this is called the SPY strength catcher. So we're grabbing that uptick that's overextended, and we're taking a short position temporarily for one day as it comes back down, and we're profiting off of that drop. Now, we could actually do this on the reverse side as well. So let me test that real quick. Okay, so I actually increased the drawdown a little bit, a couple percentages, by adding a sort of the 8-day between UPRO and TTQQ, which is a leveraged version of the tech sector of the S&P 500, but our returns now are $6.7 million. Our Colmer ratio is a little bit lower. So the Colmer ratio is essentially a risk-adjusted return that measures your drawdown versus the APY that you make in that period. So it's essentially looking at drawdown percentage and your returns, and it's giving you a ratio of like how good this strategy is. Essentially, you want as small of a drawdown as possible that reduces overall risk, so your Colmer ratio will go up. So the higher the Colmer ratio, the better the strategy is. Now, we could just leave it as is. I think what I'm going to do is just name this version 1. So if you guys want to use just this version, there'll be a link below that you can use. I'm going to make this a little more consistent. I'm going to reduce this drawdown to the 30s or so, which should increase the Colmer ratio, but our overall returns might be less, but we're getting less volatility, which is technically better, even though the returns aren't as insane. All right, so I went ahead and drew out the flow-through system a little bit more, and I tweaked some numbers. When we are green, I colored the arrows green and red as well for short. So if we're above the 100, we are going to this RSI. If we're below the 100 is below the 400, we're going to the sorting hedge. And then from here, if the RSI is above 72, we buy UVXY as a short to capture that profit on the downside. And if we're below the 72, then the RSI, we look at the 5-day return, and essentially we're buying. If it's dropping below 2.5%, then we go to the SPY 1-day return, and then we're scalping the 4% movements. Otherwise, we're just sorting through the UPRO and the TTQ. Now, by changing the RSI strategies, we're actually now making $26 million at a 1.94 Colmer ratio and a max drawdown of 58%. So the max drawdown is still the same, but we're now making $26 million. This is the part where I say that past performances is not indicative of future returns. The likelihood of $10,000 turning into $26 million in the future from this strategy is not highly likely, but we want to do everything we can to kind of maximize the potential returns. And I think by looking at the RSI with the 10-day here, you can see that anytime we're getting up into those upper areas of 72 or above, that's a good time to take a short position on it, because it's usually going to snap back down from there, and we're essentially scalping and capturing that profit. So now with that drawn out, I'm going to tweak this a little bit, and I'm going to try to drop down that standard deviation a bit. the max drawdown, and that deviation is huge as well. And it's just a very high risk thing. So I'm going to try to reduce that a bit, but I will release just this strategy for you guys below. There'll be 2 strategies that you can use for this video. All right, so I went ahead and switched out the bottom half of the hedge. Let me just do the undo real quick so you can see what I did. So we had the sort of the U Pro and the TTQQ. What I did is I changed those out to this strategy, which is essentially the 2-day moving average of U Pro is greater than the 130-day move average of U Pro. Then we're either investing in U Pro or TTQQ. We're switching back and forth. But if the 2-day move average is below the 130, then we're going defensive, which we then switch to either the SPY, TLT, or the SHY. And actually, I think I'm going to add the EEM as well here and EAFE as well. We're going to run that back. And it looks like we lost about $6 million, but our max drawdown though now is 39% instead of 50-something, which is a phenomenal increase, and our Calmer ratio is 2.72. But we did lose $6 million, but oh no, $6 million, $20 million instead of $26 million. I think the drawdown, the less drawdown is actually better, and I'm going to see if I can tweak this a bit more. All right, so I got about another 1.4 million out of it. Drawdown's about 39% and a Calmer of 2.72. So 108% annualized return. Now, a big portion of that is obviously coming from the COVID collapse. Being able to profit during a market crash is a really great thing to be able to do. But yeah, this looks like a pretty decent strategy, I would say. It's got about the same, almost the same drawdown as the SPY. We've got a lot more standard deviation, but that's understandable because it's so aggressive. And it is currently profiting while the S&P 500 is rolling over. So if you have any questions, feel free to ask me. Follow me on Instagram because I'm always posting stuff about what's happening in the stock market and what I'm doing with my money. Again, this video is educational. This is not indicative that you're actually going to make this kind of money. We're just building strategies here so that you can learn how markets move and how money moves. And if you have any specific strategy that you design yourself, feel free to send them to me. Check my links. You can either send them to me on Instagram or inside my Discord community. And I'll also be linking my whiteboard here, which you can see in the background, so you can see the actual logical flow through of this strategy. But I hope you enjoyed this. I think the next video, I'm probably going to talk about the grand strategy or the overall strategy that I'm going to be using with Composer and this YouTube channel, and how I'm going to be designing these strategies for the next months, years, and stuff, just so you can get a better understanding, because there is some high-level stuff that you need to know when it comes to using automated trading systems. But we'll talk about that in a future video.